Hello, Matt. It's still early days in the new administration. What are your thoughts on the initial direction of government policy, and what should investors be paying more attention to, or what may they have mispriced?
So if you try to distill some of the policy actions, I think it really comes down to 4 Ds. There are the deal-making tendencies of this administration, there's DOGE, there's deportations, and there's also deregulation. And I think each of these have different impacts and different pricing implications. As it relates to deal making, Trump's made it very clear that he wants to make deals geopolitically, and tariffs are the primary lever that he intends to pull. On the one hand, the currency has been stronger than we would have expected relative to rate differentials because of that. But if tariffs don't get put in place because deals are struck, then the currency could be weaker than expected. Or if tariffs do get in place, inflation may be stronger than expected. Likewise, on the subject of DOGE, the government efficiency mechanism run by Elon Musk, it's the goal to try and reduce the deficit to 3% over time, to remove avoidable waste from federal expenditures. A great goal. On the other hand, the reality is that over 80% of federal government expenditures are mandated. So it's going to be very difficult to bring this in effect without touching mandatory programs. And that includes, I would say, interest expense and defense. And so if they are successful in bringing down deficits, it could reduce growth expectations quite meaningfully, and risk perception could go higher, not lower. On the other hand, if they don't succeed in the cost savings, you could have more of an inflationary potential than people fear. Likewise, on deportations, I think people understand that the illegal immigration was a big issue over the last couple of years. But on the other hand, if you're going to move millions of people back out of America at a time of tight labor markets, that can have inflationary ramifications. And finally, when we're thinking about the 4 Ds, deregulation, the one that holds most promise, we've seen some areas of the market do very well, particularly the financials, investment banks, for example, where there's an expectation of a lot more deal making. But if risk perception goes up because of inflation concerns or geopolitical concerns, then those very stocks that benefited from the deregulation expectation may be negatively sensitive to higher risk perception. And so there's a lot of things that could happen here. The key point I'd like to get across is markets are already pricing America as great again, but it's going to be difficult to make America great again.
As I hear you talk through these issues, the phrase that comes to my mind is ignore the noise. Can you talk about how that phrase is relevant to your investment temperament and why it's a part of your philosophy?
One of the things that really helps us deal with the noise that's out there is, rather than trying to predict every zig and zag, we stay very firmly centered on this notion of scarcity value. Scarcity in market position for the companies that we're looking to buy into. These are the companies that have the ability to persist through the unexpected. And then a margin of safety in price, the value component of scarcity value, which means that we don't tend to chase the areas that have the highest level of hype in the markets. And so when we've had this sell-off in this last week due to a DeepSeek scare in the AI space, our portfolio has been largely unscathed by virtue of that sell-off because we've gone where there's more of a margin of safety and price with more persistent businesses. Likewise, if any of the deal-making tendency that we discussed before could lead to geopolitical tensions, or any of the existing geopolitical issues, Russia, Ukraine, the Middle East, China, Taiwan, become a problem, one of the things that helps us sleep easier at night is that we have potential hedges in the portfolio, be it our position in gold, or be it some of our energy-related investments. And finally, when we're sort of thinking about the risks that are out there, the one that we keep coming back to is the emergence of sovereign risk, big fiscal deficits. And we've made the point that big fiscal deficits in the US have produced the illusion of more economic resilience than otherwise would have been the case. One of the things that I guess helps us a little bit is that we're more diversified globally than the indices themselves. The indices are heavily skewed towards the US, where that apparent resilience has been fully priced. On the other hand, many other stock markets around the world trade at depressed multiples, but they may benefit from fiscal policy that's easy too. And so being diversified geographically relative to a concentrated index helps us sleep a little bit better at night and avoid the noise.
Well, thank you very much for your thoughts today, Matt. I look forward to speaking to you next time.